I have been helping entrepreneurs to start their businesses for the last 5 years, and in that time, I have found that planning for and paying business and self-employed taxes are one of the most confusing, scary, and misunderstood topics when it comes to starting your own business and being self-employed. I want to take the mystery and confusion out of the process and arm you with everything you need to know to be successful with your self-employed taxes. Therefore, I am compiling the most essential informative videos that I have previously created about business taxes. Bookmark and save this video. The information here could save you thousands of dollars in tax penalties, missed deductions, and fines. Use the timestamp menu for specific topics and chapters. Let's get started.
Hey guys, it's Jenny Silver. For those of you who are self-employed, I want to talk to you about self-employed income taxes and some of the most important things that you need to know if you are going to be self-employed. These are things that I wish someone would have explained to me and told me up front at the very start of my self-employment, but unfortunately, it is things that people oftentimes don't talk about. Now, I want to let you know I am not a CPA, I'm not a tax professional, I'm not an accountant. So it's extremely important that you understand that while I am sharing this information with you, it is not intended as financial advice, but rather on sharing personal situation experience with you. So I want you guys to take all of your questions regarding self-employment income taxes to a professional tax preparer, CPA, or accountant. The very first thing we need to talk about is that if your net self-employment income is $400 or more, you must file income taxes. This is the requirement straight from the IRS. Now, in order to know if this applies to you, you must know how to determine what your net income is. Your net income and your gross income are two different ways to define how much money you make as a business. Now, your total business income without subtracting anything is called your gross income. Your total business income minus your business expenses is your net income. So that means that if you have a net income of $400 or more in the tax year, you are required to file income taxes. Now, this is different from the regular employee income tax guidelines. So many people are often confused here because they may be coming from a low income household. They may be used to not needing to be required to file income taxes until they reach those low income filer thresholds. While self-employment income is different. If it is $400 or higher net income, you are required to file a tax return. They also go on to state that if your net earnings from self-employment were less than $400, you still have to file an income tax return if you meet any other filing requirements listed in Form 1040 and 1040 SR instructions. Now, there are some special circumstances here, so make sure that you click through the link in the video description down below to make sure if any of these apply to you. Now, if you are an independent contractor, meaning that you provide your services under contract for another business, then you will be receiving Form 1099 miscellaneous if you were paid $600 or more throughout that tax year from that business. Many of you will be receiving a 1099-K, specifically those of you who are gig workers working under specific platforms such as Uber and Lyft. Those platforms act as payment processors. So they're going to be issuing a different kind of 1099 form called a 1099-K. Now, for tax year 2021, the 1099-K will only be sent to you if you earned $20,000 or more and had 200 or more transactions. This threshold will change next year in tax year 2022, and the requirement will only be for you to have $600 in transactions to receive a 1099-K. But for this year, for tax year 2021, you will receive a 1099-K only if these two are met. Now, what you need to know here is that you are required to file income taxes if you net $400 or more, even if you do not receive a 1099. That means that if you did not meet the threshold to receive a 1099, you still are required to file your taxes. with or without that form. The next thing that I want you guys to understand is that you may be required to pay estimated quarterly income taxes going forward. Now, when you file your income taxes, if next year you anticipate that you will owe $1,000 or more in income taxes, then you will be required to pay what is called estimated quarterly income taxes. Just as an employer has to pay out your income taxes as you go, when you're self-employed, that burden falls onto you. That means that you must pay out 4 installments of what the IRS thinks you might owe come tax time. If you have never paid estimated income taxes before, this can come as a shock because the first of these estimated quarterly income tax payments is due right at tax filing time. Estimated tax payments are due on a quarterly system, with the first tax payment being due on April 15th. That means that on tax day 2021, you will owe your 2021 tax payment and whatever you owed from that year, in addition to your 2022 first quarter estimated tax payment. So, what if you are self employed and you have a tough time paying your self employed income taxes? What happens? The IRS allows you to apply for installment agreements. So I highly recommend that you apply for an installment agreement through the IRS, which can not only break up your tax burden into more manageable payments over time, but can also lessen the amount of penalty and interest that you need to pay because you have a pre-arranged agreement with the IRS. Next, I want you guys to understand that while many YouTubers create viral content surrounding why you should write off every possible expense that you can think of, I want to caution you against that. For those of you that are not used to self-employment being your main stream of income, if you ever need to apply for anything such as a mortgage, a rental application, or any sort of aid program, a loan, you are going to be required to provide your income history. Because self-employment income history fluctuates and goes up and down quite a bit, most lenders and mortgage companies, etc., are going to require an average of 3 years self-employment income history. Now, if you deduct away all of your income, that means that your taxable income is going to show as being very low on record. So while some of you may find it fitting to deduct away all of your income, many of you with future financial goals may need that income as provable income. So I think it's extremely important that you understand exactly how writing away all of that income can impact your future financial goals. Now, the last thing I want to mention to you only applies to those of you who are operating an LLC, a limited liability company. Now, most of you may fall under the jurisdiction of being a sole proprietor, which means that you did not register yourself as an LLC. If you're registered as an LLC, you will know it for sure because you had to file a lot of additional paperwork. Now, for those of you registered as an LLC in the state of California, you are required to file Form 568, which is the LLC return of income form. Now, this form is how you pay your $800 annual LLC fee. But for those of you who are filing with an online or electronic tax preparation software such as TurboTax, this form might be populated for you and filled out for you automatically through the software. But many popular tax preparing softwares do not automatically e-file this form for you. And you must actually print it out yourself and mail it into the California Franchise Tax Board. Now, the software should tell you to do this, but in many cases, if someone is filing their own income taxes, there's a lot going on and they may already be extremely confused or overwhelmed and they may miss this notification. So I want you to make sure that if you are required to print and mail in Form 568 to the Franchise Tax Board, that you do actually print and mail it in. Otherwise, you will not actually be filing your LLC return of income. So this is super important for those of you that, number one, have an LLC, and number two, are self-preparing your taxes using a tax preparation software. Okay, you guys, I hope that was helpful. Please remember to check all information and important questions with your own personal CPA or tax preparer.
Hey guys, it's Jenny Silver, and today I want to explain to you the different types of taxes that you're going to experience and need to plan for as a small business owner in the state of California. The first type of tax is your business tax certificate. Now, this is also known as a business license. However, the purpose of this business license, which is actually called a business tax certificate, is to pay taxes to your city. This is an annual tax registration which differs from city to city. It can range anywhere from $50 up to $200 approximately, depending on which city you are in. Your business tax certificate is going to be renewed annually with your city. The next type of tax is sales tax. If you're a business that is selling tangible products, or you are selling labor that is then utilized to create a tangible product that is sold to a customer, then you're going to be required to collect and remit sales tax to the CDTFA. In order to do this, you're going to need to obtain a seller's permit from the CDTFA. You're going to collect the sales tax from your customers or clients, and then you're going to be required to submit that sales tax payment to the CDTFA on a regularly scheduled reporting basis that will be assigned to you from the CDTFA. In most cases, either annually or quarterly, depending on your amount of sales. I have several full videos that walk you through the process of not only applying for a seller's permit, but answering several frequently asked questions surrounding the process and requirements. If you have more questions about seller's permits, make sure that you click the link in the video description down below. The next type of tax you're going to be required to pay is going to be income taxes. You are going to have taxable income that you are earning, and you're going to be required to report that on your tax return each year.
Now, if you have a net income in the amount of $400 or more in self-employed income, you're required to file that income on your tax return. Self-employed income is reported on Form Schedule C of your tax return, where you will note your income as well as your deductions.
Now, additionally, because this is self-employed income, you are not only going to be required to pay those federal and state income taxes, but you're also going to have to pay what is called self-employment tax. Self-employment tax amounts to 15.3%. So why do you have to pay self-employed taxes? Well, as someone who is self-employed, you do not have an employer. Now, an employer would withhold Social Security and Medicare taxes. However, because you are self-employed, you must do that yourself. Self-employed income taxes are going to be done on your tax return that you file in April.
Lastly, with income taxes, some self-employed individuals are going to be required to pay estimated quarterly tax payments in advance of the year that those payments are actually due. If you expect to owe a tax bill of $1,000 or more when your return is to be filed, then the IRS requires you to estimate the amount of tax that you are going to have to pay and to pay it out in advance. Now, if you're self-employed and you did not owe any income taxes, then this does not apply to you. However, this does begin the first year that you have a tax bill. Once you have a tax bill and owe that self-employed income tax, if you anticipate that you will have to pay $1,000 or more in the next year, then estimated income taxes apply to you.
The last type of tax that most small businesses are going to undergo is going to be unsecured property taxes. Now, this one may come as a surprise to many new, small, and specifically home business owners. In general, unsecured property tax is typically for business personal property, such as office equipment, whether it be owned or leased. Property tax rate for year 2021 was 1.1801%. Business property owners are required to file a property statement each year with the Office of the Assessor Recorder. This form is going to be mailed to your business address, and it can come as a surprise if you're not expecting it. My first year in business, I made a big mistake. I threw this form away. I didn't realize that it was tax that I had to pay, and I received a very large tax bill. What happens if you don't pay this? Well, if you do not pay your unsecured property tax form and you don't submit to them the information that they need in order to calculate it, the assessor estimates your property. What's wrong with that? This assessor has no idea what type of unsecured business property you have. They don't know how much office equipment or business equipment you have, and in most cases, they highly overestimate it. Lastly, if you're an LLC, then you're going to be required to pay an annual $800 California state LLC tax.
This annual tax is going to be due even if you are not actively conducting business or turning a profit. You have until the 15th day of the 4th month from the date that you file with the Secretary of State in order to pay this for the first time, and then it is
Okay, you guys, I hope that was helpful. I have videos on each specific topic that I talked about here in much more detail linked in the video description down below. So if you have questions about a seller's permit, about sales tax, about self-employment taxes, etc., make sure that you paying self-employed income taxes is awful. It can be extremely difficult to figure out exactly what you need to pay, and nobody is sharing what they have personally paid in the past. How can you plan accurately when, number one, it is so confusing to calculate how much you should set aside, and number two, business owners will not share any personal information about what they paid in taxes. For some reason, tax and financial information when it comes to business and self-employment seems to be completely off limits. No one wants to talk about it. Well, luckily, I am an open book, and I think it's extremely important that business owners know what to expect and can see real-life examples of what other entrepreneurs, self-employed individuals are paying in their income taxes. How can you plan, know what to expect?
My concern is, and I've got to check it with my accountant, but that this might bump me up into a higher tax.
And feel confident in what you set aside for taxes if no one is sharing their actual numbers. Now, it's important to me as an entrepreneur and as a coach that I be a resource for you guys that is pretty much an open book that shares the information that other places, people, and businesses are not comfortable sharing.
I'm not going to tell you that.
Now, I'm going to be showing you a look at my own personal tax returns. You're going to see 3 different points of my business's development and what I had to pay in self-employed income taxes. First, I'm going to show you a look at my business when it was new in development and I was not earning very much. Next, I'm going to show you a look at my business once I reached a 6-figure income. And lastly, I'm going to show you a look at the most recent tax return that we just filed for tax year 2021. When I was earning multiple 6 figures.
The first year of taxes I'm going to show you is from tax year 2011, quite a while back, and this was a product-based business. My total gross sales amounted to $53,033, but after subtracting the cost of the goods that I was selling, the total gross income was $34,316. After deducting all of my business operating expenses, I had a net profit of just $13,417. Now, there was W-2 income also on this tax return, so you'll notice that there was federal income tax withheld up at the top portion. In red, you'll see the total tax that I paid for my business and my self-employed taxes, which in total amounted to $1,895. And for California state taxes, I had to pay $1,166. Now, the next year I want to show you is tax year 2017. In 2017, my photography business grossed $163,599. After deducting expenses, the total net income from the business was $89,041. Now, there was some W-2 income on this tax return, so you will see that federal taxes were withheld due to that W-2 job. You'll also notice that I had paid 2017 estimated tax payments, which basically means that you pay your tax bill in advance. I paid in advance $11,300. In addition to what I had already paid in those estimated taxes, I also owed a balance of $7,341 in additional taxes. This means that from my business, the total amount of taxes owed for that year was $18,641. For California state taxes, I had paid estimated taxes in the amount of $1,830, and I had a remaining balance of $742, which means my California total tax was $2,572. Now, the last year that I want to share for income taxes was this most recent tax year of 2021. I'm not going to show you what my gross income was because I'm going to save that for another video, but I will show you what my net income was, which means the take-home pay after all of my expenses and deductions. In 2021, I had a net income of $352,875. For California state income taxes, I owed $15,984. Unfortunately, I did slightly underpay my estimated income taxes, and so I did have an underpayment penalty in the amount of $282, which brought the total amount due to $16,266. Now, in 2021, I was the sole income earner for our family of 4, so I did not have any W-2 income on this tax return from my husband. Now, in 2021 estimated income taxes, I estimated and paid in $85,000 for my estimated tax payments in advance. My total tax amount for my business for 2021 ended up being $81,178, so I did receive a refund back of what I had overpaid in estimated taxes.
And while that was a look at my own unique numbers, everybody is going to have a different amount that they need to plan to set aside for tax time. It's incredibly important that you understand exactly how much you should be setting aside for your own unique business. Next, I want you to click the link in the video description down below and watch the video where I show you exactly how to calculate that. Number one, I'm going to show you a peek when my business. What's a business? Like a cross between a business and a brisket? If you have a barbecue business, restaurant, I guess, is it a business? If you sell brisket? Sleeves. These sleeves. They're like bat wings. If you are self-employed, one of the hardest things to adjust to is paying your self-employed income taxes. Now, unfortunately, many of you are wondering how you can get a tax refund if you are self-employed. Now, there's a major difference in taxation between those of you who are self-employed and those individuals that are employees employed by other companies. When you are self-employed, there is no employer to pay your Social Security and your Medicare taxes. Now, Social Security and Medicare taxes are paid for by the employer, and when you are self-employed, you are your own employer, so therefore you are required to pay that 15.3% in self-employed taxes. Now, this can make tax time extremely difficult on those who are self-employed. So how can you get a tax refund as a self-employed individual? Now, when you are self-employed, your tax return is going to include what's called a Schedule C. This is the worksheet that includes not only your business income and your gross sales, but also your deductions that are removed from your taxable income. For some, their business income was small enough that their other deductions in other areas of their taxes, as well as credits filed, may actually end up resulting in a refund. Now, in tax year 2022, I want you guys to know that there is a specific tax credit that applies to this year only. This is not a deduction, it is a credit, which means money that goes straight to you. Those of you who qualify for this credit, this is going to equate to a refund. Now, I want you to watch that video, which is linked down below, where I delve into exactly what that tax credit is and who qualifies for it. The way that you may qualify to receive a tax refund if you are self-employed is going to be if you overpaid into your estimated quarterly income taxes. Now, if you are self-employed and you have previously paid self-employed income taxes, and in the next year you anticipate that you will owe a tax balance of at least $1,000, the IRS requires you to file quarterly estimated income taxes. This basically means that the IRS wants you to estimate the amount of tax that you will owe next year, chunk it out into 4 different payments, and pay each of the estimated balances quarterly. Now, because this is an estimation, some people may overestimate and overpay their estimated taxes, meaning that they had a surplus that they remitted to the IRS. When they file their income taxes, that estimated income amount, which was over what they actually owed, would then be refunded. Okay, you guys, so I hope that that helped to clear up some of the confusion surrounding why you typically do not receive a tax refund as a self-employed individual and when you can expect that you may actually receive one. If you are self-employed and you are filing your 2021 self-employed income taxes this tax season in year 2022, you could be throwing away thousands of dollars. You could be paying thousands more in your self-employed income taxes than you actually need to. I'm going to show you how taxpayers like you save an average of over $12,000 on their self-employed income taxes, utilizing self-employed tax deductions and write-offs to reduce their taxable income and save thousands of dollars. First, this video is sponsored by 1-800-ACCOUNTANT. 1-800-ACCOUNTANT is the nation's leading virtual accounting firm for small businesses. Their goal is to help you save more on taxes and spend less time and money on accounting so that you can focus on your business. Built with a team of experienced CPAs, they have served over 90,000 businesses and operate in all 50 states with dedicated experts in every industry. 1-800-ACCOUNTING offers affordable flat rate pricing and a 30-day money-back guarantee. Let 1-800-ACCOUNTING help you with your business taxes, your business startup, payroll, and bookkeeping so that you can focus on your business. Now, I am not a CPA or a professional tax preparer, so I want to make sure that you understand that this information is coming directly from either the IRS or from 1-800-ACCOUNTANT. 1-800-ACCOUNTANT has a fantastic blog with lots of resources and information on it, so I'm going to link the articles that I'm referencing in the description down below. Tax deductions work by reducing taxable income and therefore lowering your taxes overall. They essentially exempt portions of your income from being taxed. Now, in order to write off your expenses, the IRS does have a few requirements in order to make those expenses classify as being qualified. First, your expenses have to be relatively normal to your industry, and they must clearly be in support of your business's fundamental operations. Next, you must be able to provide adequate documentation of these expenses if you ever should need to prove that they actually were for your business. First is the self-employment tax deduction. As a self-employed individual, you are subject to paying self-employment taxes, which equates to 15.3%. That breaks down to your Medicare and your Social Security. If you were traditionally employed, then your employer's payroll would take care of that, but you're not. So therefore, you must pay it. But the good thing is that you can claim a deduction on half of that self-employment tax amount. 7.65% of your self-employed taxes can be deducted. The next deduction is the one that seems the most obvious, and it is your operating costs. Anything that you need in order to have your business in operation can be written off as a tax deduction. Next, you can deduct labor. Any employee payroll, contractor labor wages, bonuses, or commissions are all deductible.
Next are professional fees. Next are professional services. If you hired a lawyer, an accountant, or some other type of professional to work with you in your business, then those fees are tax deductible. This also applies to fees that you might pay for something such as a membership or a subscription, as these are deductible as well.
Next is the home office deduction, and this is a big one, but there are some specifics here in order to qualify. You cannot simply work anywhere around your house in a communal space or a space that you use for something else and claim it as a home office. You must have a dedicated space that is used only for business and is the primary place where you conduct your business. Now, if you are eligible for this deduction, you can then claim a portion of all of your home-related costs as business expenses.
Next is a deduction for depreciation of property. If you have purchased a large investment in terms of business property, then you shouldn't necessarily deduct the cost of the whole investment right away. What you can do is to deduct the depreciation of value over time.
Next are deductions related to marketing and advertising. If your business is spending anything for marketing or advertising, such as creating business cards, social media ads, SEO services, influencer marketing, or a variety of other things that would fall under this category, then it is deductible. Next are organizational expenses. Anything you need to organize and establish and set up that business is going to count as a deduction. Next are your internet and phone expenses. 1-800-ACCOUNTANT states that for a home office or a personal phone that you also use for business costs, you can deduct a fraction of the total cost based on an estimate of your relative business use. If you have a dedicated phone or internet service plan that is used only for businesses, then you can deduct the full cost. Next are your building costs. If you rent or lease a space that is dedicated for your business, then you are able to deduct that. In addition to just deducting the rent, you can also deduct anything that is associated with maintaining or operating that space, such as utilities, repairs, insurance, etc. The next deduction is business, travel, and transportation. As long as your trip is intended entirely for business purposes, then every expense incurred on that trip outside of your regular area is tax deductible. The next tax deduction is vehicle usage. Even if you own a personal vehicle and you are utilizing it only partially for business, you can still deduct those partial expenses on your tax return. Document your mileage when you use the vehicle for business purposes, and this way you can claim a deduction based on your specific mileage. It should be noted that this does not include travel to and from your office and residence. Next is professional education. If you underwent any courses, any developments, any seminars, etc., that led to the development of your business or yourself as a business owner, then those are tax deductible. Next, you can deduct things such as your insurances, your taxes, your licenses, and your permits. All of these are necessary costs associated with the operation of your business. Next are banking costs and credit card processing fees. These, once again, run in line with normal operation of a business. If you are holding money in a bank and you receive charges for that bank, or you're collecting money and having to pay a fee into that system, then it is tax deductible. Next are meal deductions. Now, this does not mean that you can deduct your lunch every day from simply working and needing to eat, but rather if you are specifically taking your clients out to a meal, or if you're bringing food back into your business to be consumed by your employees. Generally, meals are 50% deductible, but there are a few meal-related costs that can be 100% deductible. In order to be 100% deductible, it must be food or entertainment provided as part of a party for the entire company at once, or it must be something officially included as compensation for your employees for whatever purpose. The last deduction I want to go over with you today is on retirement contributions. The amount that you're able to contribute depends on what type of retirement plan you currently have set up, but every year you're allowed to contribute a maximum amount to your retirement plan. Those contributions are tax deductible. 1-800-ACCOUNTANT recommends that it would be a smart idea to max out your deductible retirement contributions before the end of each year, especially if you are likely to find yourself in a higher income tax bracket. Why? Because this allows you to defer paying taxes on that income until you withdraw that money at a later date. And lastly, if you have not yet seen my video about self-employed sick leave due to the pandemic, next I want you to click on that video to see if you qualify for an up to $5,000 deduction based on that pandemic-related requirement. Okay, you guys, I hope that was helpful. Please remember to click the link in the video description down below in order to access 1-800-ACCOUNTANT's wide variety of services.
What do you do with your money when you get paid if you were self-employed? I'm going to walk you through exactly what to do to take out the mystery and confusion. But first off, before you take in any money at all in your business or your self-employment, make sure that you are set up with the following accounts. Number 1, a personal checking account. Number 2, a business checking account. Number 3, a business savings account, and a self-employed retirement account, such as a SEP IRA or a solo 401k. You will also need a bookkeeping method, such as QuickBooks, Xero, Mazuma, or hiring a CPA. And lastly, always consult with a tax professional or a financial planner. Do not trust anyone's advice on the internet, including mine. Number 1, set aside money for taxes. You should always consult with a professional on exactly how much you should be setting aside for your unique situation, because this amount is going to vary according to many different circumstances that are unique to you and your business. But a generalized rule of thumb is to set aside 30% of your earnings for income taxes. You will be obligated to pay self-employment tax, which across the United States amounts for 15.3%, federal income tax, and state income tax. These three taxes are going to be calculated based on your net income, which means your profit after your expenses and deductions have been removed. However, setting aside 30% of your total sales is a good way to ensure that you don't accidentally underestimate. Next, determine if you're obligated to pay sales tax. This should be determined prior to making the sale so that you can collect that sales tax along with the transaction from your customer. But either way, even if you did not collect this, you still are going to be obligated to pay sales tax if you are selling tangible products or labor that later on down the line will result in the sale of a tangible product to that same customer. You will both need to hold a seller's permit as well as remit that sales tax to your state sales tax board unless you are using a marketplace facilitator in order to conduct your sales who collects and remits that sales tax for you. Sales tax laws differ from state to state, so it's very important that you read up and understand the sales tax laws for your specific states in which your business operates, as well as where your customers are purchasing from. Next, set all tax money aside immediately into a completely separate savings account until tax time. Number 2, determine how much you will be paying yourself. Transfer this amount from your business checking account to your personal bank account. This can be done at any frequency, at any time, and in any amount. This is called doing an owner's draw or an owner's distribution. Number 3, determine how much you will be contributing to a self-employed retirement account. Money invested in a SEP IRA or a solo 401k is tax-free, meaning that you can save for your retirement and lower your taxable income. There is a maximum contribution to your self-employed retirement funds of up to $69,000 for 2024. And lastly, number 4, ensure you keep your bookkeeping updated and generate a profit and loss report monthly, which shows exactly where your money is going, what your expenses are, and what is the most profitable in your business in order to help you make the best financial decisions and plans for business growth. Profit and loss reports can be automatically generated using your bookkeeping software on most platforms.
Hey guys, it's Jenny Silver, and today I want to talk to those of you who are business owners as we enter into tax season about small business red flags that could trigger an audit. The IRS is doing more audits than ever this year, so that you understand how to avoid getting audited at all costs, because we all want to limit the possibility that we could unintentionally trigger an audit by something that could have been avoided. Now, I want to be really clear with you. I am not a CPA. I am not a tax professional. I highly recommend that you consult with your tax professional regarding any tax concerns. But as a business owner, these are the things that I wish someone would have told me so that I could start making sure that I stay up to date with them early on in my business from the get-go. First is failing to report income that has already been reported to the IRS. Now, when another business pays you for your work as an independent contractor, then they are going to need to issue you a 1099 tax form. That business that paid you must issue that 1099 tax form not just to you, but also to the IRS. This means that if you fail to report that 1099 income to the IRS, whether it be accidental or intentional, hopefully not, then the IRS will know because they will have already had that income reported to them. The next red flag is taking suspiciously large deductions. An example of this would be if you deduct 100% of your personal car expenses as a business deduction. The next big red flag is misclassifying your employees or failing to issue the proper tax forms. The IRS can be alerted by the worker themselves or others that the worker was improperly classified as an independent contractor when they should have been an employee, thus requiring the employer to file payroll taxes.
If the IRS receives this notification, then they may trigger an audit.
IRS has 3 years after you file a tax return to audit you for that tax year. However, there are a few exceptions. If you have significantly underreported your amount of gross income, then the IRS can take up to 6 years. Additionally, if you fail to report $5,000 or more in foreign income, then the IRS statute of limitations extends to 6 years. Now, if you have never filed taxes or the IRS determines that one of your returns is in fact fraudulent, then the statute of limitations extends indefinitely. Okay, you guys, I hope that was helpful.
If you want to start a California LLC, a limited liability company, then now is your time, because doing it now will save you $800 in taxes, which won't be available if you wait. California LLCs are required to pay an annual $800 LLC tax to the state of California. But the state of California has passed a law which allowed California LLCs to waive that $800 tax on their first year in business. The catch is that 2023 is the last year that this benefit is available. And in order to take advantage of having the full year of 2023 be tax-free, you need to start your LLC now in the month of January. Waiting to file your LLC and doing it later this year will mean that you still will receive that $0 tax benefit for that $800 fee. However, your $0 LLC tax-free year will only apply to a few months, as this goes away January 2024. So I strongly recommend that for those of you who have been wanting to start or convert your business to an LLC and protect your personal assets or take the tax benefits that come along with being able to choose S-Corp taxation status after becoming an LLC, then use this as your motivation to start your LLC now so you can take advantage of saving that $800 limited liability company tax. Now, if you don't know how to start an LLC, I have 2 videos you can choose from for help. One for if you want to handle everything yourself, and one if you want to do it the easy way and have it professionally filed for you. For those of you who want to have your LLC professionally filed for you, I recommend filing with InkFile. You can actually file your LLC for $0 with InkFile plus the state filing fee, which is really minimal. Click the link in the description down below. But regardless of how you choose to file, if you have been wanting to become an LLC, then now is your time before this benefit expires. So it's officially the end of tax year 2022. In 2022, you made your first sales to customers, and now you do not know what you should be doing to claim that income on your taxes. Let me walk you through the process that you will now need to undergo so you know what to expect. The IRS states that any self-employed income, specifically if you earn self-employed income over a net income of $400, needs to be claimed on your income taxes. If you worked as a contractor providing services to someone, you may receive a 1099 tax form from that person or business. If you made sales on a third-party payment processor, you may receive a 1099K tax form from that organization. These tax forms will be delivered to you no later than January 31st. If you don't receive any tax forms, you are still required to claim your income on your taxes regardless. Your tax preparer or tax software will ask if you earned self-employed income. It will also ask if you received any Form 1099s. Reply yes to these questions. This will then prompt your tax software or tax preparer to complete a Schedule C on your income tax return. This is the area where self-employed income is claimed on your taxes. Schedule C will ask for your gross or total income from your business or self-employment. It will also be where all business deductions are entered in, resulting in your net self-employment income. This amount will be subject to state and federal income taxes within your tax bracket, as well as self-employment tax, which amounts to 15.3%. This covers Medicare and Social Security taxes.
If you anticipate that next tax year you will owe $1,000 or more in taxes, you will be required to pay estimated quarterly taxes, which is your next year's estimated tax bill divided into 4 installments. The first of these installments will be due this April. 1099 NECs for non-employment compensation can be an incredibly confusing aspect of self-employment. Understanding the ins and outs of these can be incredibly tricky. So we are going to break this down in a way that simplifies it for you so that you understand exactly what your tax obligations are with 1099 NECs, whether you be someone paying independent contractors or someone who is self-employed and receiving that money. When you pay or receive money for performing services, doing labor, or doing a specific job, and you are not an employee, the IRS requires that income to be tracked using a specific tax form. This allows the person receiving the money and the person paying the money. These tax forms are both issued to the recipient of the money as well as filed with the IRS and are used in filing income taxes. Now, there are 2 different categories of people that need to understand 1099s. The first category are those who are receiving the money and who are being paid. And the second category is those who are paying someone for their work. First, let's talk about those on the receiving end of the money. If you are earning self-employed income in the amount of $400 or more in net self-employed income, you are required by the IRS to claim that income on a tax return, file and pay income taxes on it. Regardless of whether or not someone sends you a tax form for that income, it is your obligation as someone who is self-employed to make sure that if you're earning $400 or more, that you file and pay that self-employed income tax return. Because you are not an employee, you are therefore self-employed. Self-employed individuals will file this income on Form Schedule C of their tax return. Schedule C gives spaces for you to claim the income that you have earned as well as list any deductions for business expenses that can lower your taxable income. These deductions are going to include things such as business operating expenses, professional services that you pay for, or wholesale goods that you might be purchasing. These deductions are then subtracted from your gross or total income, and what you're left with is your taxable income. This taxable income is going to be subject to 3 different types of taxes. Now, when a business or individual pays a non-employee, they're obligated to create and issue a 1099 NEC tax form, non-employee compensation, if they paid that individual $600 or more within the year. There are 2 different types of workers. There are employees and there are non-employees. Employees are hired by a business to perform a specific job, given specific instructions on how to perform that job, and often receive training on how to perform those duties. Employees are put into a payroll system, and when they receive a paycheck, the employer pays Medicare and Social Security taxes, along with several other benefits, into payroll taxes, which are removed from the employee's paycheck. Independent contractors, however, do not receive specific instructions, choose when and how to perform their duties, and are paid in full without having Social Security and Medicare taxes removed from their pay. Because these taxes are not paid by an employer to the agencies, the contractor is the one required to file and pay these taxes themselves. These taxes are known as self-employed taxes. Self-employed taxes equates to 15.3% of your total taxable income, and this covers Social Security and Medicare. That self-employed tax is paid along with your income tax return. When the tax year is over, if you have been paid $600 or more by a specific individual or a business, they will then issue you a 1099 NEC. Sometimes the business might not fulfill their obligations and you might not receive the form. However, you still are obligated to file and pay taxes on the amount that you received. When you receive 1099 NECs, either you or your tax professional will enter it into your tax filing and include it in your income tax return. This will be entered on that Schedule C, followed by your deductions, and that taxable income that remains after those deductions is going to be subject to 3 different types of taxes: self-employed taxes, federal income taxes, and state income taxes. Now, if you expect to owe $1,000 or more in the next tax year, then you are also obligated to pay estimated quarterly income taxes. Essentially, this is what you think you might owe next year in taxes, broken down into 4 even payments and paid quarterly. Anything that you overpay will be refunded through a tax return, but anything underpaid will be subject to a penalty. Now let's talk about understanding 1099 NECs if you are someone who is paying a non-employee. If you paid a non-employee $600 or more over the course of the year, in total, adding up all those separate times that you paid them, then you are going to be required to issue Form 1099 NEC for non-employment compensation. Now, if you need to issue Form 1099 to a worker, you first must collect that worker's information in order to generate the form. In order to do this, we use Form W-9, which is available at irs.gov. It is best to issue and collect a W-9 form from a worker before you pay them to ensure that you have all the information needed and that form is secured before they actually start the work. However, if you did not do this, then make sure that you collect that W-9 from them before you issue that 1099. The W-9 is going to include information such as their social security number or EIN, their personal address, and a few other things. So make sure that this form is kept confidential within you and your business and the IRS and the individual only. Next, you will need to create, issue, and file Form 1099 NEC. If you use a payroll software for paying your independent contractors, such as my personal favorite, which is Gusto, the link is included in the description, those softwares have the option to automatically generate, issue, and file these forms with the IRS as well as with that non-employee. If you do not use a payroll software, don't worry, you can quickly and easily generate these using an online tool. My favorite is tax1099.com. I'm not sponsored by them. They are just very fast, easy, and very low cost. 1099s will be issued to individuals, partnerships, limited liability companies, or estates. In most cases, corporations do not receive 1099s, but there are a few exceptions. The IRS gives the following examples of who should receive 1099s. Anyone who provided professional services like accountants, engineers, or architects, non-employee salespersons earning commissions, independent contractors who get paid for services, goods, or travel, or received benefits, professionals who received referral or fee-splitting fees, non-employee entertainers for services related to your business, and certain people who got golden parachute payments after a merger or acquisition. Most payments to corporations are not included on 1099 NECs except for the following. Now, if you are someone that needs to create and issue a 1099 tax form, click on this video popping up, which is going to walk you through the process of creating those 1099s. Let's talk about understanding 1099 NECs if you are someone who is paying a non-employee. If you paid a non-employee $600 or more over the course of the year, in total, adding up all those separate times that you paid them, then you are going to be required to issue Form 1099 NEC for non-employment compensation. Now, if you need to issue Form 1099 to a worker, you first must collect that worker's information in order to generate the form. In order to do this, we use Form W-9, which is available at irs.gov. It is best to issue and collect a W-9 form from a worker before you pay them to ensure that you have all the information needed and that form is secured before they actually start the work. However, if you did not do this, then make sure that you collect that W-9 from them before you issue that 1099. The W-9 is going to include information such as their social security number or EIN, their personal address, and a few other things. So make sure that this form is kept confidential within you and your business and the IRS and the individual only. Next, you will need to create, issue, and file Form 1099 NEC. If you use a payroll software for paying your independent contractors, such as my personal favorite, which is Gusto, the link is included in the description, those softwares have the option to automatically generate, issue, and file these forms with the IRS as well as with that non-employee. If you do not use a payroll software, don't worry, you can quickly and easily generate these using an online tool. My favorite is tax1099.com. I'm not sponsored by them. They are just very fast, easy, and very low cost. 1099s will be issued to individuals, partnerships, limited liability companies, or estates. In most cases, corporations do not receive 1099s, but there are a few exceptions. The IRS gives the following examples of who should receive 1099s. Anyone who provided professional services like accountants, engineers, or architects, non-employee salespersons earning commissions, independent contractors who get paid for services, goods, or travel, or received benefits, professionals who received referral or fee-splitting fees, non-employee entertainers for services related to your business, and certain people who got golden parachute payments after a merger or acquisition. Most payments to corporations are not included on 1099 NECs except for the following.
Step number 1, determine if you are obligated to report your payments. If your business paid an independent contractor $600 or more in total payments throughout the course of the tax year, you are most likely obligated to report these payments. Step number 2, collect a W-9. If you haven't done so already, send the contractor a copy of IRS Form W-9 in order to collect and verify their taxpayer ID information. This form is linked in the video description. Step number 3, go to tax1099.com to generate the form. This video is not sponsored by Tax 1099. I have simply found that this is a very simple, fast, and cheap method of generating these forms. For non-employee compensation, you will be creating Form 1099 NEC. Enter in the information for your independent contractor and your business. Send a copy of this form to the contractor, to the IRS, and keep one for yourself. This must be done no later than January 31st of the new tax year. Tax1099.com will file this form to the IRS and send it to the contractor for you as long as you select that option. Step number 4, when filing your own taxes, be sure to enter in the payments to your independent contractors on your business taxes, as these are business expenses and are tax deductible. Hopefully this simplified the process for you. Now, if you want to automate this process for next year, I highly recommend signing up with Gusto to pay your independent contractors, generate those forms, and issue and file them automatically. Super easy, and the affiliate link is in the description down below.
California seller's permits and California sales tax. These are two things that confuse entrepreneurs, sole proprietors, and small business owners. Today, I want to explain to you what you need to know as a small business about California seller's permit and California sales tax. California seller's permit is obtained through registering your business with the CDTFA, the California Department of Tax and Fee Administration. When you register for and obtain a California seller's permit, it then authorizes you to not only sell tangible goods, but also to collect and remit sales tax. In the state of California, you are required to collect and remit sales tax for all sales of tangible goods, as well as the sale of labor that then goes into a final tangible product that you have sold to a customer.
The CDTFA has industry-specific sales tax guides, so if you're uncertain if a specific product or service should be subject to sales tax, then click the link in the video description down below, locate your industry, and find more detailed information there. It's also always best to check with a certified tax professional. Now, for those of you who do not need a permanent seller's permit but will be engaging in temporary sales, you are required to obtain a temporary seller's permit. These are going to be issued to individuals with no permanent place of business, and they cover a selling period of 90 days or less at one location.
California sales tax amount differs from county to county.
Current sales tax rates according to the county and city are all published online on the CDTFA. I'm going to link the guide in the video description down below.
The state of California needs to receive this sales tax paid to them one time. That means that if you are someone that is selling tangible products directly to customers, you will then collect and remit the sales tax to the CDTFA. If you are someone that is utilizing a third-party marketplace facilitator, which is a fancy name for a website or a marketplace that collects the sales tax instead of you, then you are not required to hold a California seller's permit or to collect and remit the sales tax. Why? Because the California Marketplace Facilitators Act stated that if a marketplace is already doing that, they are already collecting the sales tax and remitting it, then California is happy. They do not need to receive it twice. So let's say that you are utilizing a third-party marketplace to conduct your sales. How do you know if you need to obtain a seller's permit and collect and remit that sales tax? Head over to that marketplace and search their handbook and online guides. Look for sections where they discuss sales tax and check and see if that marketplace is collecting and remitting the sales tax or if it is left up to you. If you can't locate documentation there, then look in your transaction history. Is the marketplace collecting and remitting the sales tax from the customer directly, or are they not charging sales tax at all? If that sales tax is charged, does it get paid out to you, or do they keep the sales tax themselves? For those of you who are not utilizing a marketplace facilitator that is handling all of the sales tax for you, you will need to obtain a California seller's permit. Obtaining a California seller's permit is free and the application isn't extremely complicated. I have a full video that walks you through each step of the application, so watch that video in the link down below as you complete your application. Once you have obtained your California seller's permit, then next you need to make sure that you are charging your customers who are purchasing tangible goods or labor that then results in the sale of a tangible good later on down the line. You will need to ensure that you are charging them the proper amount of sales tax. Use the link below in order to locate the current sales tax rates according to your county. Business owners can either charge a separate line on the invoice for sales tax, or you can incorporate it into the total price. What the state of California is concerned about is that you report to them all of your total sales that are going to be subject to sales tax and that you actually pay that sales tax. So it can be up to you if you decide to incorporate it into your total item price or itemize it separately. The next thing that you need to know is that you're going to be required to remit that sales tax over to the CDTFA. In most cases, the CDTFA asks for you to send them over their sales tax quarterly, but it can differ according to the amount of sales you have, the type of business, etc. Check your specific information on your seller's permit and account login info with the CDTFA. When it comes time to pay your sales tax, you're going to log into your online account at the CDTFA. Click on through to their online filing system and you will be asked a series of questions about your sales for the quarter.
The CDTFA is going to assign a filing frequency for you with specific due dates. They either will ask for you to prepay quarterly in advance, to pay quarterly, to pay monthly, or to pay annually, based on how many sales you report and your anticipated taxable sales at the time of registration. The CDTFA is going to let you know exactly when you need to pay, as well as send you out reminders. You can locate this at the time of registration in the documentation you receive in your online account at CDTFA's website, as well as send in email reminders and mailed reminders. If you're required to file quarterly, then January, February, and March sales tax will be due at the end of April. April, May, and June sales tax will be due at the end of July. July, August, September sales tax will be due at the end of October. And October, November, December sales tax will be due at the end of January. For those who are put on a yearly reporting basis, your sales tax will be due by January 31st. In addition to reporting and paying your sales tax, you are going to be required to keep adequate sales records of any sales that you make, as well as any sales tax that is collected. Additionally, you're going to be required by the CDTFA to notify them if you change your business address, change the ownership of your business, add or drop a partner to your business, sell your business, buy another business, or if you discontinue your business, you are required to close out the account.
Okay, you guys, I hope that helped to take out some of the confusion surrounding California sales tax and California seller's permits. Now, if you need more information such as a full application walkthrough, specific Q&A regarding seller's permits, the Marketplace Facilitator Act, and paying your sales tax, click the links in the video description down below. It is October. Which means that it is time for me to file my 2022 quarter 3 California sales tax. I'm going to show you exactly how to file your California sales tax on the CDTFA's website. If you don't already hold a seller's permit and you need to get that in place, then I want you to click the link in the video description down below where I show you exactly how to do it. In the state of California, you are required to hold a seller's permit and collect and remit California sales tax to the CDTFA if you make 3 or more sales of tangible products within a 12-month period. Now, you're going to be required to do this either on an annual or a quarterly reporting basis. This is going to be dependent on your own unique business, and when you apply for and are granted your seller's permit, the CDTFA will tell you exactly what that reporting schedule is. Keep in mind, you have to still file a sales and use tax report with the CDTFA on your reporting schedule, even if you didn't actually make any sales during that period. They still want to see the report of that $0 amount.
First, you're going to need to gather the number of your total sales that you made on products or services that will result in a product, and your amount of sales tax that you collected from your customers. Now, what I report sales tax on are my photography services and products, and I slowed those way down this year because I was focusing in other areas. So I only have a little bit here to report. To get my totals from the software I use to process my payments, next I'm going to log into my CDTFA account. If you do not already have a CDTFA account, then you can either utilize their express login over here on the right-hand side and use the code that they have sent to you with your notification to file your taxes, or you can create an account with the CDTFA. Down here, you're going to select the account that you're going to be filing the report for. Next, select the specific tax return that you intend to file, which is most likely up here at the top. You can see that I have processed a few of my sales tax reports late, and I have paid penalties for that. Sometimes life is just too busy. First, we're going to enter in the amount of total sales. Then below that, we are going to enter in the purchases subject to use tax. This means that if you had inventory that you purchased in the intent to resell and you did not resell it, you ended up converting it to either your own business use or personal use, then you must claim that here because you will be taxed on it. Additionally, you're going to be asked for any sales of business assets, fixtures, and furnitures that are associated with your business. Next, you'll enter in any sales at fairgrounds, and then this is going to be followed by non-taxable sales, which are going to be deducted from the amount of sales tax that you owe. And this is going to include sales to other retailers intended for resale, non-taxable sale of food products, non-taxable labor such as repair or installation, sales to the United States government, sales in interstate or foreign commerce, and sales tax that was included in your total sales reported. This is going to be the line item that many of you will enter in here. If you collected sales tax and that was included in your total amount of sales, make sure you enter in the amount of sales tax that was collected right here. This way, you will not be paying sales tax on your sales tax. Next, you're going to be allocating your amount of sales to the particular district where you made those sales. Now, if you're like me and you accidentally made a little error this time around and you inputted the wrong amount of sales tax in one of your invoices, then you are going to have an excess of sales tax, meaning that you collected more than you actually are supposed to pay. The CDTFA is going to have you remit and send over to them all that excess tax. Most likely, you will not see this screen on your own tax filing unless you made the same error. Next, you're going to see a summary screen followed by a screen to input your information. You're going to be asked if you're a paid preparer, so unless you are a paid professional tax filer, in which case you would not be watching this video, then you're going to click no. Next, click submit, and then you're going to be taken to this confirmation screen agreeing to these submission terms. Following this, you're going to see your confirmation here, and then you're going to see a series of options down below. The first option is the option that you will want to click on right away, which is make a payment. Here you will be able to either pay immediately or schedule your payment using a credit card, a debit card, a transfer, and you can schedule it to occur in the future. Lastly, you will want to make sure that you open this as a PDF and save a copy of the confirmation so that you have it for your business records.
Okay, you guys, I hope that was helpful. If you have further questions on your California seller's permit, then I want you to click the link that is popping up on screen right now where I go over a lot of those frequently asked questions. It's hard to bend.